Good afternoon, everybody. I think we can get our webinar rolling. We'll have everybody come back on camera and turn your audio on, and we'll be underway here shortly. Thanks for joining us. I'll kick it over to Steve for some opening comments, and really looking forward to our time.
Wonderful. Well, good afternoon, good evening, wherever you may be in the United States. I'm Steve Van Houten, our fearless leader. Today, we have a great guest. We'll be talking about tax planning because we do financial planning. That's one of the things that we have control over. We can't control the markets, can't control the weather, can't control our moods most of the time, but we can control how we operate. Financial planning gives us clarity and confidence over our finances. We're all about getting our financial house in order and keeping it organized. That's one thing I believe we do particularly well, and we coordinate all the moving parts in your financial life. So thanks for joining us. Thanks for another great year together. We hit some milestones with some new clients, some new staff. Now we're 13 and a half people strong to serve you. We're now in 46 states, so I think we have pretty good coverage. So just forever grateful for your partnership with us over these many, many years. On the fourth generation of families now. So taking care of the grandbabies of these big lineages. So it's really, really fun from my perch. And so we'll take it over to Luke and we'll get this train on the road. But thanks for showing up.
Great. Special shout out too, today is Mr. Brian Fields' birthday. So I've been told if we don't use the entire allotment of the hour we've been given, we're all gonna sing happy birthday in unison. So hopefully there's enough Q&A to make sure that we prevent that from happening. But happy birthday, Brian.
Thank you.
Another year around the sun. To echo Steve's comments, always look forward to coming on the webinars with you to bring either market updates or financial planning ideas, or even non-related things to your finances. This particular topic is really timely for a couple of reasons. First, with the passage of the big beautiful bill earlier in July, it does bring about some tax updates that are really impactful for us right here in 2025 and beyond, bringing a lot of clarity. I got to hear from Bill earlier this summer at the LPL Focus Conference. Actually, Steve and I attended his session, and that's really what was the catalyst for setting up this conversation today. But I have history with Bill dating back to the start of my career at Putnam Investments. Prior to Franklin acquiring Putnam, Bill and I were in the same office back east in Boston, and it's really cool to see a guy being able to present to our clients who was so passionate about financial planning. Really encouraged me to get my CFP in the early career days. So always good to see you, Bill. Thanks for making time available, and really looking forward to our conversation. You do a great job, and just appreciate your thought leadership. So John, we'd love to have you officially kick it off from the Franklin Templeton side of things, and appreciate your partnership and all the great work we get to do together. So John, I'll turn it over to you.
Luke, good seeing everybody again. Let me introduce my friend Bill Cass. He is a veteran of the business, been doing in the business now for 35 years. Bill oversees our wealth management team at Franklin Templeton. Now this is a group of subject matter experts, educating advisors and clients in areas such as taxes, retirement, estate planning, and education funding. He also spends a lot of time on Washington policy, and that is going to be the focus of our conversation today, breaking down the new tax law and what you might want to be thinking about from a planning perspective before the end of the year. So with that, Bill, thanks for taking the time today. We appreciate it.
Okay. Happy to be here. Always happy to support great partners. Steve, you and your team have been great partners to us at Franklin Templeton and also during our Putnam years. Luke, great seeing you sort of come up the ranks when you were, sort of just out of school, starting at Putnam Investments and now working with the team now and serving clients. For people that are joining us, we work there's a lot of financial advisors across the industry. Some stats suggest there's 300 financial advisors. There's a lot of great teams out there. You are in very, very good hands with Steve and the rest of the team. That's all I say. Great partners, great commitment to their clients, great commitment to financial planning, and not just, making sure that they look and address your needs from a holistic point of view. How are investments going to affect taxes? How is retirement going to play in? If you have college savings needs, et cetera, et cetera. So great to be here today. I'm going to share my screen. I'm going to share some slides and encourage people, at the end, we'll do some Q&A and encourage people to use the chat feature. And let me just get this slideshow. And also the other thing I'll make a commitment to, if you have a question maybe you didn't think of today, or that you think about, next week, reach out to your team there. And Steve, Luke, and the rest of the team, they know where to find us. We're happy to respond to an email. We're happy to get on a quick phone call. So we're here to help you get some clarity on all this. And what we're going to do today is I am going to talk about the One Big Beautiful Bill Act, now law. And I'm going to focus on some things we need to be thinking about right now. As Luke said, most of these provisions kick in tax year 2025. So we have a little bit of time left before now and the end of the year. There's important changes to deductions. There's certain phase out limits. So I think we always want to be focused on year-end planning anyways. I think this year it's a little bit more heightened because we're sort of grappling with some of these new tax provisions and to plan for. So this isn't one of these deals where, hey, we got this new tax law, most comprehensive piece of tax legislation in the last few years. We'll just, we can wait till 2026. We'll figure it out. No, we really have to address it now. So I encourage you to sort of take what I'm saying in. We're not going to make you experts in the next 20 minutes or so, for sure. But most importantly, engage with your advisor, engage with the team there on your own personal situation. Everyone's going to be a little bit different. That's the beauty of working with an advisor. They can really cater to your specific needs. So that's super, super important. I'm going to be sort of focusing on the high level. So overall, some comments from my standpoint. I think it's good news overall. I don't think this is a perfect tax bill. I don't think I've ever seen a perfect tax bill. But I think it's one of the things I think is super helpful is that we avoided an expiration of the 2017 law. Remember, the 2017 law fundamentally changed our individual tax code, but that was set to expire at the end of this year. So this new law avoids that expiration. So that avoids an increase in rates and changes to brackets and things like that. So overall, I think that's good news. I think the added good news with this is that sort of the core pieces of the tax law, meaning the brackets, the tax brackets, the rates, the estate tax provisions, the standard deduction, some others, are extended permanently. So unlike most of the tax laws we've seen dating back to the early 2000s under the Bush administration, typically have an expiration date. They expire 7 years down the road, expire 10 years down the road. We're sort of grappling with this lack of clarity. So I think this is helpful because it's, there's some temporary stuff in here I'll point out for sure. But the core pieces of it are permanent. That doesn't mean they won't change. Because I always like to say, there's no such thing as permanent tax law. It's permanent until a future Congress changes it. But I think the absence of an expiration date helps. It certainly helps with planning. So clarity, permanence. It's super hard to plan effectively if you just don't know what the rules are. So at least we know what the rules are for the most part, and then we can sort of understand them and apply them to our own sort of personal situations. So let me talk about first, I'm going to skip through that slide, but let me talk about some of the expiring provisions that were due to expire that were extended. I mentioned the rates and brackets, the standard deduction, the alternative minimum tax. That's good news. The alternative minimum tax, if Congress didn't do anything, would have greatly expanded in terms of how many people would be subject to it, and we sort of avoid that. One area I want to focus on, because it's super important, especially for people in California and other high-tax states, is the SALT deduction cap, the deduction for state and local taxes. So property taxes, your state income taxes, can be significant, right? New York, New Jersey, California, my home state of Massachusetts, right? Certainly, Illinois, California, others. So the big centerpiece here is that the amount you can deduct for state and local taxes, if you itemize deductions on your return, has been increased from $10,000 to $40,000. That's significant. There's a reason that happened politically. There were 20 or so House Republicans just from New York, New Jersey, and California that indicated they were not going to sign on to the broader piece of legislation until they got some type of relief with the SALT deduction cap. They didn't want to be going into those 2026 midterms and not have anything to show for it, not bringing anything back to their districts and saying, hey, we got you some relief from the SALT state and local tax deduction cap. So 10,000 to 40,000. It's the same for individuals as it is for married couples. So it's a bit of a marriage penalty there. And it does phase out. This is a key area. I do want to emphasize this. So once your income, technically your modified adjusted gross income, exceeds $500,000 as a household, that's individuals or couples, so the same amount. Once it exceeds that limit, you start to lose that SALT deduction, or at least the increase in the SALT deduction. So if you get to a point where you get to $600,000 in income, you revert back to a maximum amount you can deduct of $10,000. So from a planning perspective, maybe you're well under that income threshold and it doesn't really apply to you, and that's fine. But for people that are sort of around that threshold, they need to be carefully thinking of their planning right now, between now and the end of the year. Are there things they can do to sort of keep their income at a level where they're not going to face that phase out? So I'll give you a simple example. If I was at the cusp of that threshold, 500,000, if I add more income, I'm going to start losing that deduction, that increase. And assuming I have a lot of property taxes, I can take the full $40,000 deduction, right? If I was thinking about doing a Roth conversion at that point, I'm not sure it would make much sense, because you'd be adding income, paying taxes on that income, but also reducing the deduction at the same time. So that's what we're talking about in terms of year-end planning. To what extent, if you're in that ballpark area, can you stay closer to 500,000 and avoid, being phased out of that deduction? So that's a key area of planning, a key discussion you want to have between now and the end of the year if you're impacted by this. We have a whole host of, and by the way, that SALT deduction, I forgot to mention, that's good for the next 5 years. So that's one of those temporary things. So 2025, remember, goes into effect this tax year, and then through 2029. Now we have a whole host of other temporary tax deductions that are new as well, that we sort of have to get our arms around. These are all available for the next 4 years. So seniors, deduction for tips, a deduction for overtime pay, a deduction for auto loan interest. These are all good starting in 2025 for the next 4 years. And then, who knows what's going to happen after that, right? It's going to depend on Congress and what's going on at that point. The interesting thing with these deductions is that you can utilize them, you can claim them, whether or not you're itemizing deductions on your tax return. So even if you're taking the standard deduction, you can still use these extra deductions. You can't use the SALT deduction. So the state and local tax deduction, the only way you're going to be able to benefit from that is you have to itemize deductions on your tax return. And remember, the standard deduction for this year is just over $15,000 for individuals and $30,000 for married couples filing a joint return. So that's sort of unique. This new deduction for seniors and the rest of the deductions, they all have phase outs, as you can see on this slide. So for example, married couple, at least if they're 65, they're taking advantage of that new senior deduction. They start to lose that deduction at income levels of $150,000. It would be half of that if they were individuals. And so you could have a married couple filing a joint return. They're at least 65. They're below that income phase out limit. They could get an extra $6,000 a piece in a deduction. So added on to their standard deduction, an extra $12,000 total. That can be a significant deduction to reduce their taxable income. In fact, for a lot of people, it will. What we're looking forward to this tax season, we're going to see the largest amount of refunds aggregate around the country that we've seen in more than 15 years because of these tax deductions and because they're so new. There hasn't been any changes for people that are still working. There hasn't been any changes to, for example, withholding tables. So it's going to be a big year for tax refunds. No taxes on tips, really, it's a deduction for tips, same for overtime pay. This deduction for auto loan interest, that one, I sort of joke about that one because you can deduct up to $10,000 of auto loan interest annually. I'm not sure who has $10,000 in auto loan interest. You'd have to buy a really expensive car to try to get that much in interest. And by the way, it's got to be a domestic car. So it's not like you can go out and finance a Ferrari and write off the interest on that. It's got to be a car where final assembly takes place in the United States. Lastly, the Trump accounts. So the Trump accounts, brand new savings account. It's for minors, so under 18. As you can see on the slide, it's up to contributions of up to $5,000 per year. Let me break down the tax treatment. So these are funded with after-tax dollars. And then when the child turns 18, basically that calendar year where they turn 18, they basically turn into traditional IRAs. So between, before 18, before that calendar year where they turn 18, you can't take any money out. So there's no early distributions or anything. Child turns 18, now they're basically traditional IRAs. If you took money out, it might be subject to a penalty and taxes. So yes, there is some benefit because you're putting after-tax money in it, they grow tax deferred. But when this money comes out, eventually it's going to be taxed as ordinary income. One thought on these for people looking to take advantage of them is maybe when the child turns 18, maybe you suck it up, you pay the taxes on it and convert it to a Roth at that point. Again, these are not going to be available until next summer at the earliest because there's a lot of work the government has to do in order to sort of, build the plumbing around these, figure out all the details. That takes time. They will be funded, or for those people with newborns in 2025 through 2028, then if you have a newborn, the federal government's going to help, get these accounts started with $1,000 sort of seed funding. So certainly I would take advantage of that. A couple other comments on these. Overall, I think it's a nice option personally. And again, everyone's situation is going to be different. I would not use these in lieu of 529 accounts to fund higher education. My 3 kids are in their 20s. My youngest one is a senior at University of Delaware. I got one more tuition payment left. I'm super excited about that. 529s made a huge difference. Saving in 529s over many, many years since they were born made a huge difference in us and our ability to fund college education. So I would still use 529 funds for college or for higher education expenses. Again, they can be used as qualified apprenticeship, K through 12. So I would still use that. But if I wanted to do something extra and for long-term savings for a child eventually, that's when I might use a Trump account. That's just, anyways, my personal thoughts on that. All right, so we talk about a lot of things that are happening this year. These new deductions, the increase in the SALT deduction, these all take place in 2025. We have some other changes that aren't happening until next year on the charitable side. One is good and one is, sort of a little bit of a takeaway. So I'll walk you through that. First of all, beginning next year, there's going to be a new charitable deduction available for non-itemizers. So remember, you do your tax return, you either take the standard deduction, you don't have to work for it, the government just gives you a number, or you itemize deductions. If you have enough, you can exceed that standard deduction, you would itemize. So for people who take the standard deduction, the government's basically saying, beginning next year, and this is permanent going forward, they're saying, hey, if you're giving money away to a charity, then we're going to give you a little bit of a deduction. You're going to be able to deduct up to $1,000 given away to a charity, or up to $2,000 for a married couple filing a joint tax return. These deductions have to be made in cash, and they have to go to a public charity. So you can't, deduct appreciated stock or something like that and take advantage of this provision next year. So it's got to be cash to a public, just to a regular, public charity. So you can't, if you're putting money in a donor advised fund, it's not going to, meet that requirement. But it's a little bit extra. Hey, if I'm taking the standard deduction and I am, giving some money away to charity as well, because that's what I like to do, then at least I'm going to get a little bit of a deduction next year. The next change is going to impact people higher income giving more to charities, itemizing deductions on their tax return. And this one is basically what's happening is that the government's coming and saying, okay, beginning next year, you're not going to benefit tax-wise from giving money away to a charity unless the amount you give or until the amount you give exceeds 0.5% of your adjusted gross income. Sounds super complicated, so let me take you through an example. Again, this begins next year. That's a key point. So this year, let's say my adjusted gross income is $500,000. I'm just picking a number out of the hat. I give $10,000 away to a charity. My deduction this year will be $10,000. Straightforward, makes sense. However, beginning next year, because I have this haircut of 0.5% of my AGI, my deduction would only be $7,500. So thinking about year-end planning, if you're itemizing deductions, charitable deductions on your tax return, right? And you're going to be subject to this haircut next year potentially, does it make sense to accelerate more charitable giving into this year, maybe using a donor advised fund to do that instead of like giving money away next year? Maybe not. It's going to depend on your particular situation, but that's just something I'm going to throw out, and that's something you might want to follow up with the team on to talk about your personal situation. So again, itemizing deductions, giving money away to charities starting next year, there's going to be a little haircut that you're going to take from a tax benefit perspective. All right, then one of the last areas I want to cover is the estate and gift tax. So this number here, 2025, of just under $14 million, this is what we call the unified lifetime exclusion amount for gifts and estates. This really is the amount of your net worth per person. Everyone has the number, an amount of your net worth that you can shelter from federal gift taxes while you're living or federal state taxes after your death. So everyone's walking around with this number. This number was supposed to be cut in half for next year, but Congress obviously passed this tax law and avoided the expiration of these tax provisions. So not only did they avoid the expiration, it increases to $15 million next year, and then it's indexed for inflation going forward. So, for example, as a married couple, I have $15 million to either give away during my lifetime or leave to my heirs at death, and my wife has the same amount. So at $30 million total, my household, we just don't have to worry about the federal estate tax. It's just not something we have to worry about. Now, if I win the mega bucks or something, yeah, I'll let you know, and maybe that situation changes. But as of right now, I don't, we don't really have to worry about this. We have to plan for Massachusetts, because Massachusetts has a state death tax if you pass away with more than $2 million in your name. And you can get to $2 million very, very quickly if you talk about real estate and maybe what's left of an IRA or something like that. But on the federal level, we just don't have to worry about that. So one of the things that when we're traveling around and talking to people, say, okay, and by the way, some people, maybe they sold their business, they're ultra high net worth, they're above that $50 million limit or $30 million as a married couple, or will be above that with the trajectory of their wealth. They certainly have to address it. They certainly have to work with a qualified estate planning professional. There's lots of different, more advanced planning tools and trusts that can be used to mitigate that sort of issue. But for most of us, we just don't have to worry about that. So one of the things that we're talking about is when we're thinking about passing wealth, maybe to the next generation, can we be maybe smarter or more efficient from an income tax perspective? And let me explain that. So even though the federal state tax doesn't apply, well, actually, I'll share a specific example. There's an example in my family. So someone in my extended family passed away this summer. He's 80 years old, and great guy. And he had three basic assets he passed to his boys, two sons. The three assets were this. He had a lot of money in an IRA, set over $1 million in an IRA, seven-figure IRA account, right? He had a, really sizable, life insurance proceeds, and then they sold the house. So those three assets were going to the two boys. Let's just take a look at those assets from an income tax perspective. The IRA has to be withdrawn within 10 years when you leave it to the next generation. There's limited exceptions, but generally that's the way it works. And it's fully taxable if it's not a Roth. This was not a Roth. It was a traditional IRA. So both of those heirs have to take the money out within 10 years, pay all the taxes on it. So that's not not as tax efficient an asset to pass to the next generation. The life insurance, tax-free. Can't get more efficient than that. The sale of the house, step up in cost basis. You'd own the house for decades. They're selling the house right now. There'll be no capital gain on it because he held it into his death. It's going to the boys. And then, upon sale, they'll be able to avoid the capital gains taxes on that. So two very efficient assets to pass the next generation. One very inefficient, the IRA dollars, right? The two heirs, let me break that down. One is 50, high tax bracket, will be in a high tax bracket for the next 10 years. He's a high earner. The other one is 35, the son from the second marriage. Does not make a lot of money, does not need a lot of money, doing fine. Is married, so they're under the joint tax brackets, which are more beneficial. So the way the estate plan worked is they both got everything split in two. So they both split that IRA, for example. In a more tax efficient estate plan, maybe more of the IRA dollars were left to the younger son who can better absorb the tax hit from having to take the money out over 10 years. So again, it may or may not be a consideration for you and your estate planning, program, but it's just something to think about in terms of, hey, if we're not going to have to deal with the federal estate tax, maybe we can be smarter as we leave assets from an income tax perspective. So that's something, that I've been certainly sharing during my travels. So just wrapping up some of the conversations, I think, year-end planning, we need to engage now. The first step with year-end planning is we need to get a good projection of your income for 2025. That's going to tell you what's my marginal tax bracket. It might even give you some sense of, hey, how much income can I add before the end of the year and still stay within that bracket or avoid going to a much higher bracket. So we need to get that income projection. That drives a lot of the decision making at the end of the year here. A lot of these new deductions, they have different phase out limits, especially that SALT deduction. That's the big one for California and other high tech states. So that's something to think about. We talked about charitable contributions. One reminder, no changes here. This isn't anything new, but reminder for those that are over 70.5, you can take money tax-free out of your traditional IRA if the funds are sent directly to a qualified charity. It's a great way to give. It's called a qualified charitable distribution. If you're taking the standard deduction anyways, and you give some money away to a charity, take it tax-free out of the IRA instead. Someone's going to have to pay taxes on it, either you while you're living or your heirs if they inherit it. So it's a way to avoid, you're sort of killing two birds with one stone. You're avoiding taxes, including maybe taxes on a required minimum distribution, and you're giving to a charity at the same time. Roth conversions and using Roth accounts, even though, I think we're still in this lower tax rate environment that was supposed to expire and got extended. I think Roth conversions can make a lot of sense. I like the premise of having some of my assets in a traditional IRA and some in a Roth. And that way I have some diversification depending on what taxes look like in the future. I think it's a really tough, sort of plan to say, hey, I'm going to take my huge IRA, I'm just going to convert it all to a Roth and pay a huge tax bill. So this is the time to talk about Roth conversions. Maybe you can do it gradually over time and build that Roth balance up. And then, like I said, in terms of estate transfer and wealth planning, is there an opportunity to take a fresh look at that estate plan and see, where the assets are going and who's inheriting them and what tax brackets are they likely going to be in? And also, remember, everybody needs an estate plan, right? We need to, if you list a beneficiary on your IRA or your 401k plan, that's estate planning. If you have a will, that's estate planning. Do we have a revocable trust to avoid probate? That's estate planning. Do you have a healthcare proxy, an advanced medical directive? Maybe you get to a point where you want to have a power of attorney. God forbid if someone can make decisions if you can't make decisions for yourself. So, just because hardly anyone's going to, owe federal estate taxes doesn't mean we don't have to focus on estate planning. So Steve and Luke, I'm going to leave it there. Covered a lot of ground and sort of we'll poll to see if there's any questions.
David, why don't you go ahead and make that comment just about what you're seeing from a planning standpoint, or just a quick call to action for folks as we approach the end of the year in a hurry.
Absolutely. Thanks, Luke. Bill, awesome presentation. Really appreciate it. We've got lots of questions from clients last few months about the tax bill. So if we don't get some questions, I've got some for you here in a second.
Yeah,
But
I got
for
two
clients,
also, maybe four.
we're really excited about helping you with tax planning as we come to year end. Many of you know we have some great software, Holistaplan, that's been helping us to look at your tax returns and analyze your specific tax situation so that we know what's going on. We can look for some of these tax planning opportunities, whether it's a Roth conversion, right, gifting charitably, and seeing how that impacts your tax dollars. So we have some powerful tools to help you with that. We've been doing that already throughout the year. If we haven't got your 2024 tax return, reach out to us, right? Whoever your advisor is here on the team. I would love to get a copy of that, take a look at it with you and see, what's the change going to be for 2025? Like Bill said, can we do a projection of your income in 2025 and see how that's going to be different for you, for 2026, 25 this year and 26. What are the changes going to be? How's it going to impact you? So excited for that. Happy we have that capability here at the firm. And then with that, Luke, I'll turn it to you and see if we've got some questions. I think Steve's got a couple in the bat here. I've got one as well.
Steve, why don't you kick us off? We'll shoot Bill a question again. Click the raise hand button down below if we can get to a live question. I think my wife did a courtesy button click, maybe on accident, but Mariah, we're coming for you.
We're in trouble. No, Bill, thanks again. Practicing for almost 35 years, I look at generations and mindset. And when I was David and Luke's age, it was kind of I understood Social Security intellectually, but now that I'm a card carrying Medicare person, it's a whole different ball game. So we really clearly differentiate if you're an accumulation person, still working, still building up, preparing, lots of things to do. This new tax bill gave 401k catch-ups if you're 60, 63. So there's a lot of, I don't call them mouse traps, but it's tricky. It's tricky. So if you're age 60 through 63, you've got an additional catch-up. This year, we can still do the pre-tax. Next year, we're forced to do the Roth. So that's going to change some planning. So I cannot reiterate enough how practicing financial planning today is very different than when I first started in the 80s. In the 80s, the whole mindset was take the deduction now, you'll be in a lower tax bracket when you retire. I don't know any one of our clients that's in a lower tax bracket at age 70, 75 than they were when they were 35. So I cannot reiterate enough. We had the tools, we got the heart, we got the commitment, we got the brains, and it's the one thing we can do to be proactive. I can't control Washington. We try to control everything we can't control. This is the one thing that we can control. And your longevity, inflation is still I believe, our greatest risk. So
I'd agree with that.
Add that along the way to Bill's great comments there.
Yeah. Bill, I think when you kicked off your comments, I know we've got clients all over the US, but we do have a fair concentration here in California, and then also a number of folks on the East Coast as well. So that SALT deduction going up from 10,000 to 40,000, that's a remarkable move that, as you pointed out, should be more refunds going out when folks file in 2025. So I think that's definitely a win. I know cost of living has really soared. Everything is just more expensive. So that should provide some significant relief. Again, capped above 500,000. That is it reduced dollar for dollar, Bill, or is it just a step function? Does it just go away?
It's a step function, but it's, I always say it's not really gradual. It's like a cliff, because once you get to 600, now you're back to 10,000. The way, not to bore you guys with math, but the top tax bracket's 37%. So that's the highest, that's the top tax bracket. However, if you were at 500,000 of income and gonna write off the full 40,000, Luke, and for every dollar you add from 500 to 600, your tax rate on those dollars is 45%. So I wonder, like, how the heck is it 45? Because the top tax bracket is 37. Well, it's 45 because it's the tax bracket, plus at the same time, you're losing the deduction very quickly. So who wants to pay a 45% marginal tax bracket? And obviously, I'm not even getting into California at that point.
Right.
So yeah, I think you guys are doing all the right planning and have the tools to help people avoid those. Those are huge tax traps. The average person out there just doesn't have a clue about that. It's very complicated.
Especially in recommending conversions for clients who are in and around that $500,000, and you said modified adjusted gross. So that's not even
Income.
After some
Exactly.
deductions off the top. So really important. Bill, something that I'm seeing more and more, I think with the strong markets we've had over recent history, you talk about your children making their way through college and being so thankful for the prudent saving you've done over the years in the 529. Can you comment at all? I know it's not part of your presentation, but we're starting to get more questions about residual dollars in 529s and some provisions as far as transitioning those dollars to Roths. Can you talk about that a little bit? I know it's not a part of the presentation, but I think it's relevant.
Yeah, I think it's super relevant. I agree, Luke. 529s have just gotten so much better. I remember, I keep saying this, as 35 years in this industry. Steve, maybe you do the same thing. Do you ever use the term back in the day, or back in my day, or back in the day? It should be like a swear jar. Every time I say that, I should put money in a jar, especially to the younger people.
I know.
But back in the day, you couldn't even use 529s if your kid's going away to college and you bought a laptop. I mean, that was there's been so many positive changes at 529, K through 12 and qualified apprenticeship programs, now even credentialing programs, now CFP and other professional credentialing programs you can use a 529 for. And the big one that happened a few years ago is moving. If you're left with money in the 529 plan after all the dust is settled, you can move it to a Roth IRA. There's some limitations. You can move a total of 35,000 per 529 beneficiary. But let's say that my daughter, who's graduating in the spring, let's say we had leftover 529 money, I could move it over to her Roth IRA. Tax-free. It's just, it would just move from the 529 to Roth. The most I could do, it would act as a Roth IRA contribution. So I'd have to be within those contribution limits. So 7,000. So I couldn't do the 35,000 all at once. But I think what the government's making a strong statement here. They're saying we need people to save for college or higher education, and not just college, apprenticeship programs for sure. We need people to save. We need people to start early, and we want to take objections away. We want to take away the objection is, okay, what if I don't need it all? Well, there's another avenue, and it's a pretty good avenue too. So that's the background, I think, in terms of that provision.
Yeah.
Plus,
that's super helpful.
You could make a modest gift early on and just let that thing ride, and the choices, it'll serve generations, and you can change beneficiaries, you can go down the food chain, you can fund a future college education for grandchildren if it's not way even before grandchildren show up. So I think the flexibility we have and the creativity plus the tax-free accumulation of capital invested over the long period of time it's really powerful. I think they're really underutilized.
Thanks, Steve. It was really eye-opening to me because when I was taking money out of the 529, and remember, again, this is my personal preference. My
Yeah.
kids, I said to my kids, all right, you're on your own for grad school, right? So for us, I really stopped putting money into 529s when they got to be, 16 or so, because we're going to take it out anyway. So
Sure.
to what extent you can get it in there early and go through some market cycles and take advantage of that, and maybe dollar cost average over time is
Sure.
super, super valuable. But when I did take the money out, you get a tax statement from your provider and it breaks out, okay, what part of your, you took out 30,000 for the year or whatever. What part was your contribution and what part were earnings? And it's like, wow, look how much that I took out that I didn't really have anything to do with. It's just in the market. So it's a it was for me anyways, it was probably 50-50, in that
Yeah.
ballpark. So
Right.
Wow.
So and we serve, the accumulators and the people in distribution, and most of our people, if they do have families, they say, what's just smart things to do? Or they say, shoot, I wish I would have done this. So we get to kind of make those amends and use, full clarity looking in hindsight, and we can, make adjustments, along the way. But the software that we talk about did not even exist for us. You had to work with your CPA. Now, to make it really clear, we don't give tax advice legally because we're not CPAs, enrolled agents. So we're very clear about check with your own CPA for the ultimate authority, but these are tools which we never had before.
no.
I had with my team today, we are working with a business owner client and her CPA doing planning for the rest of the year. How much salary should she take? What deductions should she accelerate, decelerate, Roth conversions? See, all the things that you've discussed today, we had that conversation. So the CPA has homework, we have some homework, and she has some homework. So as David alluded to, it takes more time. A lot of advisors just play with the money. They don't really do what we do. So I believe the clients who really appreciate this sort of extra touch, not being self-serving, but it's a lot of work, but it's very meaningful, and it does make a difference, I think, in the overall, quality of the financial plan.
It makes a difference in dollars and cents.
Yeah.
So we can't control the markets, but a smart tax planning program, conducted on an annual basis, I always say that's like adding horsepower to your portfolio. If you're the more efficient you are, the less drag on that portfolio. That's math. The other thing I'd say, Steve, too, you mentioned business owners. It was a little out of scope today, but if you have business owners, this new bill is a bonanza for business owners. Beginning this year, really, think about cost recovery. So if I am expanding my business, I'm buying computers, I'm buying equipment, where normally I'd have to write that off for tax purposes over a number of years. Now you can write it off all in this tax year, and that's permanent.
Right.
So 100%, they call it bonus depreciation, but that's the gist of it. And there's other really, really appealing things in the tax law for business owners. We're going to see that really take off in 2026 for sure, I think.
Definitely. We definitely, still have a retirement crisis in America. You look at through all the information, all the data out there that's available at fingertips, still the financial competency and people who really feel really confident hasn't really changed in 30 years. So we try to pick up the slack, and we'll meet you where you're at. But we really, really, really try to help people see that, educate them, and to help them make really good decisions.
Bill, we do have a question through the chat box. We have an anonymous attendee asking, does the extra standard deduction for those 65 and over apply even to spouses who are not U.S. citizens but over 65?
Yeah, this is the ultimate check with your tax professional answer. This one, I will tell you that. generally, if they're able to file a joint return, then they should be able to deduct that. But that's one where I'm going to absolutely say check with your tax professional on. That can get, when we start talking about, when we start talking about, taxpayers in the U.S. who are foreign citizens, married, then we get into some really muddy waters.
Mm-hmm.
I'll tag on to that a little, Bill, because I've some
have at
questions
it.
about that senior tax deduction. Um, uh, the phase outs, right? There's a $150,000 phase out you meant. What does that mean for a client? Maybe they have $200,000 of income, right? One, and then two, with that, didn't I hear something about Social Security wasn't going to be taxed anymore? What happened to that?
Let me talk about Social Security first, but I love talking about this. Frankly, it gets me fired up. Earlier this week in Omaha, Nebraska, I did a really big Social Security client event, and I talked about this. So Social Security, the no taxes on Social Security, that was, I paid zero attention to that. Not because I'm, my political affiliation or whatever, just because I know that you cannot make changes to Social Security, structural changes to Social Security. You cannot make them legally without 60 votes in the Senate.
Yeah.
And they weren't getting the 60 votes in the Senate. You can pass tax and spending legislation with a simple majority in the Senate for sure. That's sort of the game plan both parties have used. But with Social Security, it's exempted from that rule. So what they did is they sort of shoehorned this new senior deduction over the next 4 years as a proxy for no taxes on Social Security. It's been confusing people. So, it's 60 votes in the Senate. They can't just go and take your Social Security benefits. There's a much, much higher threshold to touch Social Security.
Got it. So, Bill, you're traveling the nation. I'm sure you've had a few questions. Oh my gosh, I read that Social Security is going broke. Should I worry about see my checks stop? And I know it's a controversial thing. I know it's an actuarial, it's a demographic situation, but changes must be made. And
Absolutely.
it seems like we don't, John knows this, we don't make a change until we have a huge crisis right in front of our looming face. But any comments of thoughts or
yes, I
reducing
definitely
some fears or angst on
I
this?
definitely have thoughts, and this is what I told the audience the other night, and I tell audiences all around the country. Be very careful looking at media reports, wherever you're getting your news from. Everyone's trying to, it's the bad news or we all know what sells in the media, right?
Yeah.
So yes, I don't want to diminish that Social Security has a looming solvency crisis for sure. Okay. Probably in 2033, let's call it that. But I always encourage people, be careful about bringing that into your decision-making process. So you hear people, I've had it in my own family members, older family members in my family. I've had a conversation with them. Hey, I need to take it at 62 because the government's, it's not going to be there. And I think that is a bad way of thinking, because you could be living to 95 and you locked yourself into a lower monthly benefit for many, many years. So I go back to 1983. That's the last time they made major reform to Social Security. It was basically, we were going through a very similar thing.
Mm-hmm.
I went back and looked at this. They basically started to take action a year or so ahead of that solvency crisis. So if we're talking about a solvency crisis 2033, I'm wake me up when it gets to be 2030, Steve.
Yeah.
Here's the good news is that it's not that challenging of a math problem to fix it. You make some changes here or there, and you can buy yourself 75 or 80 years worth of solvency, and there'll be some pain. If you're still working, that wage base, how much, to what extent when you owe Social Security taxes right now, $176,000 of wages, and it sort of shut, you don't have to pay anymore. That's going to go up, I think, for sure. I think the retirement age is going to go up. I'm 58. I don't think my retirement age is probably going to go up. My kids are in their 20s. Their retirement age is probably going to go up. And there's some other levers they can kind of press. And so, I mean, I think it's politically, it's not really the math, it's more the politics with it. But I do think they're going to address it before the solvency crisis.
Right.
But we got to get closer there to force their hands.
Right.
Awesome. Oh, looks like we got one more question,
Oh my goodness.
and this would probably be, we'll say our last question to be respectful of your time. So this says, did I hear that OT needs to be singled out on W-2 in order to get the deduction? Do people need to work with their employer for this to be listed?
Yeah, that's a really good question. And on the overtime deduction, one thing I want to be clear on the overtime deduction is it's so when you get to that threshold where you're going to get overtime, let's call it 40 hours, and now you're going to make time and a half, for example. It's only the half of the time and a half is deductible. I just want to make that clear. Only the actual overtime, not all the not all the compensation after you get to that overtime sort of range. Yeah, they're making changes right now. Employers are working with their payroll providers to sort of separate out and do that and make some changes to provide better reporting. But ultimately, how it's reported. How it's reported isn't going to eliminate you from taking the deduction. And again, this is a go back to your tax professional type of message. But if you have legitimate overtime and you can back that up and have the documentation of that fact, then you can take the deduction. Just because your employer doesn't get their act together in time versus another employer isn't going to prevent you from shouldn't prevent you from taking that deduction. If that makes sense.
Yeah,
Awesome.
got it.
Bill, do you have time for one quick question?
Yeah, I'm good. I'm not.
Okay. Because one quick, I know Steve, Brian have talked a lot about this, the going away of the old stretch rule with inherited IRAs, non-spousal. I have a handful of various non-spousal inherited IRAs that are subject to this 10-year rule,
Yep.
where we have that minimum RMD, required minimum distribution, we need to take out each year. But kind of like the Roth conversion decision, making sense. Do we take more, almost levelizing, looking at 10 years or 7 years, how much time we have left? But when the rule first came out, there was some folks who were saying you're better off taking the minimum and the tax deferral for that
All the way to the end, yes.
all the way to the end is super valuable. But if you're in a super higher tax bracket, I know everybody's situation is different, but as you've chewed on that, do you have any perspective that you can share where certain tax brackets definitely fill up versus, maybe certain situations take the minimum? I know it's a generalization, but something
Yeah,
more
no,
and more
I
of.
hear what you're saying, Luke. I think, at the high level, what I tell people when they're looking at their IRAs, traditional IRAs, not Roth, is there, while I'm living, can I spend more of it within more favorable tax brackets? Can I donate more of it? Can I convert more of it? Because the IRA dollar, because the next generation has to take it out within 10 years and pay taxes on, it's not as valuable a way to pass wealth from one generation to the next. I'd rather pass life insurance proceeds, or I'd rather pass a stock that got step up in cost basis or something like that. But be that as it may, it's going to happen. So I think it's going to be different for most people. I think a lot of people are going to look at that normalization, but there might be something to say, hey, let's just take out the minimum and let's do a balloon payment in year 10. I think that's the power of having your type of software, and to be able to run those types of numbers, I think, is super important. But here, I'll give you another scenario. You could have a scenario where someone inherits it and they're 60, right? And they've left their corporate job and they might do consulting, but they're okay. And maybe they have a couple years where they're not really working, people go through these transitions all the time. They get laid off from a big company or something like that. And maybe they have a year or two where their earning profile looks a heck of a lot different. If I had an inherited IRA, I'd want to take more out in those years. So it's about, you got 10 years to play with it. How can we be as tax efficient as possible? Now, in some cases, people are going to need the money, and that's going to trump everything else.
Right.
If they need the money, then, taxes are taxes, and they're going to have to rely on the cash flow. But so I think there's a lot of different variables that could come into play based on the situation. I think most people will probably take a little bit out each year. Remember, if it's a Roth, You don't have to take any minimum distributions out those first 9 years. If you can wait to the 10th year, take it all out and let
Oh,
that thing
beautiful.
grow tax-free, that's
Absolutely.
really what you want to do, if
Yeah.
possible.
And
That's a
the,
win.
the value of generational planning that we serve sometimes second generation, third. So let's say grandpa gets up in years and he's a widower, and the kids really don't need the money, but their kids are in high school. So we'll bypass the children because they're going to need that money for college education anyway. Kids are in a zero tax bracket if you're no longer dependent. So there's a lot of still the planning, looking at the rules, looking at the specific case, and there's some cases it works out just perfectly, and it's a win-win situation, lowers the taxes, and so planning pays off. It really does.
Does. It does. It makes it's in a lot of cases, I can tell you just from some of my, family members and my grandmother, poor plan, it had nothing to do with investing.
Yeah.
Poor planning done by her attorney back in the 70s led to a huge problem. She
Huge.
ran out of money. This woman had a wealth level. She should never ran out of money, and won't bore you with the details, but it was a very simple thing. It was adding someone as a co-owner on her main asset.
Yeah.
And
totally.
it was a
Yeah.
disaster. It was
Yeah.
just one thing, seemed innocuous at the time. It had impact over 3 decades and ended up her running out of money in her 90s, and it was really unfortunate.
That's horrifying. Horrifying.
Yep.
Wow.
Well,
It
you've been
wasn't anything
patient.
done. It wasn't
You guys
anything
are great.
fraudulent. It was
yeah.
just bad. It was just not thinking the whole thing through. They should have used a trust.
Yeah.
I think we're at time. Steve, I'll leave you with a closing remark.
Oh no. Who's left? For the few people who are left, no, seriously, this is so good, and I just encourage. There's always something to do. We uncover all the rocks and look to opportunities, and it's always changing. It's always changing. I know less than I did 30 years ago, but I have better resources and a lot of younger, smarter people around me. So I believe we do a really good job of being thorough and getting clarity to get confidence. So on behalf of Lifetime, our team, our partners, Franklin Templeton, John, and Bill, happy Thanksgiving, and really we're grateful. We're really very, very grateful for this partnership that's lasted a very, very long time, and I think will continue to be sustainable. So take care of you and yours, your families, and we're always here for our clients and your friends who want a second opinion. Whatever you need, we're SEAL Team 6 at your disposal. So thank you.